Hello, everyone. A very warm welcome to all of you in this panel discussion. If I just start with something like, as we are battling with the COVID and looking at the new ways of doing business, uh, on this panel today, we are going to discuss a very timely topic, which is, has COVID-19 reshaped digital banking? I think the time can't be better than this. And let me go straight into the topic. And we can see banking has changed a lot in last 5 to 10 years. And one of the key changes, and you will agree with me, there is one particular element in the banking system which has started getting a lot of attention, and that is data. Let me come to you, Hartnell, first. And from your point of view, how you see role of data in today's fast-changing banking environment, and how it is reshaping the digital banking when banks are trying to make best use of data and adopt new technologies. Over to you, Hartnell.
Thanks, Raj, and good to see you after a long period of time. I hope you're keeping well. Yeah, so just sort of by answering your question and saying that data is actually getting the limelight. And you're right by saying that people are now relooking at their strategies more with regards to data. One thing that I can clearly highlight is that data is the foundation for digital transformation. And if you don't have a proper data strategy, then you'll actually find a bit of gaps when you're actually trying to form your digital transformation strategy. So what I'm seeing changing within the data enterprise environment is that people are actually recruiting more data skills. We're having people now requesting to hire more data scientists to look at predictive use of data. Governance and proper understanding of data governance and management is becoming also a topic on discussion. And all this is being driven by people shifting from brick and mortar processes to actually digital transformed enterprises. How this is shifting the digital space. Number one, I'm actually seeing more people now changing their strategies. And I can tell you, there are participants over here today that if you did not change your strategy when COVID struck, then you're actually lagging behind. More people are now using their digital devices, and it's up that you sit down with your enterprise executives, come up with ways of how to target these new customers and their shift to digital transformed devices and processes, and know how to attract or retain them better. So data in that space, we are seeing more of use cases being requested on how can we use data to predict how customers are going to behave within different channels, because now you're having channel migration taking center stage. You're having people coming up with new business products, and they're requesting you to analyze the data and tell you which products are going to be taken up by customers better, and more uses actually being developed in that space. Thanks, Raj.
True. Very true. Completely agree. And I firmly believe in today's fast-changing world, there is no space for gut feel anymore. Understanding the data, interpreting it, taking action, iterating, and constantly moving forward is the new name of the game. And these days, every decision is backed by the data analytics. On that note, let me come to Wane. And I have personally experienced many innovations in the past in African banking sector. How you see African banking sector going to experience next types of innovation post COVID-19, and in which of the areas you are going to see the innovation? Over to you, Wane.
So thanks for the question, Raj. Exciting times we live in today. I always give the example of how today you see a lot of cross-pollination between industries. That's beginning to happen more and more. Technology-based industry players or resources are moving across into the financial sector. What that already gives me an indication of is that there is a convergence in technology and solutions. What I anticipate is in the next coming probably 3 to 5 years, we will see a lot more collaborations happening between different key stakeholders in delivering new products and services in terms of modernization. One of the big challenges that I know banks have been grappling with is banks are relatively mature when it comes to financial service products. The problem that we face today is the cost of deployment or the cost of service is extremely unproductive when it comes to bottom line performance in terms of product delivery towards consumers. So a big shift that I'm anticipating in the short to medium term is that a number of fintechs, a number of banks, a number of telecommunication companies are going to converge. It's called the Great Convergence that I'm beginning to predict. A lot of this will continue to happen over the next period of time, and it's speaking to delivering more efficient, cost-effective products and services, irrespective of the segment, whether it's micro-lending, whether it's wealth management, whether it's even more productive insurance-type products. I think this is something that I anticipate is already, I know it's already happening post-COVID. A lot of these type of models are beginning to develop, especially around COVID. Telcos and banks are doing a lot of distribution work together to unbundle the traditional distribution structure. But I see a lot more beginning to happen in the short to medium term.
Perfect, perfect. And you know what, Wane, that's the beauty of talking to someone who has seen all three sides, whether it is fintech or bank or telco. Thanks for these insights. And now, continuing the discussion on innovation in banking in the aftermath of COVID-19. Dennis, let me come to you now. And I think for the last few years, I always see many banks and financial institutions talk about innovations. And I was talking to someone and I was told the Ghanaian government has eased account opening regulation, and some similar measures have been taken in Nigeria where BVN can be used for opening the digital accounts. How you think banks can generate real results and achieve strategic objectives by leveraging data in new and innovative ways, as well as through regular adoption of technologies and not looking at technology as a milestone deployment every 5 years or 10 years. Over to you, Dennis.
Okay, thanks, Raj. Very interesting questions. So banks, should I say historically, were challenged because with the way we've been built, regulation and the different hierarchies and the departments you are mandated to have. When you say digital and the banking, in banking, it's almost like an oxymoron because we are not built to be digital, you know. But now COVID is upon us, and for us who are taking that lead in the digital teams within the bank, it's been interesting to see how that has forced customers on one hand to begin to adopt more digital solutions and products. So that has been interesting. That has been very exciting for us. So how does that help us to build out their expectations? So what we're doing, I actually cover the SME segment, but I can speak generally even to the retail segment. So what we're doing is ensuring that we are, so from a design point of view, we're designing our products around consumer behaviors. So consumers as individuals, but then businesses as entities. You know, so you are looking at the entire customer journey from how did they discover the product, how did they onboard onto the product, what is that experience, you know, to ensure that we are not trying to take them out of behaviors and patterns they're already used to, but we're building our solutions around that which is already existing. You know, so that has been what has been leading us, but more so we've seen that more so with COVID-19. And that is what has really got the team, if you like to say, going into sleepless nights, because we're thinking about how we can be more innovative around the customers' behaviors, around the way businesses are structured. You're looking at the MSE, the middle SMEs, the micro SMEs, before you move to the larger SMEs. So we have a lot of differences, big nuances within the segment that we have to address when we build out the solutions. And COVID-19 has afforded us that opportunity to really focus more on customers in the digital space, because even they are forced to be in digital. And when we look at our transaction trend, although COVID-19, during the lockdown, I should say, more transactions were digital, but now that we've eased it a bit, we've seen that those customers that adopted digital solutions or who started increasing the transactions on digital solutions are doing more now. So there's already a change in behavior, and we intend to ride on that and deliver better services to our customers. Yeah.
Perfect, perfect. I always think that letting go of the familiar is key for the future post-COVID. I was talking to some bankers a few days back, and I was my opinion was, with the pace of change in technology and client preferences, disruption needs to be in the DNA of every company, and that should be without the fear of failure. If I can give an example, when we look at automating how we sign up new clients, success can only happen if both relationship manager and the clients are comfortable shifting away from the paperwork, which they were used to found tedious, but if they were very familiar with it, they need to move away from the familiarity. One, if I just want to come back to you, and you are running one of the biggest, if I can say, the digital setup in the region, from the banking perspective. Uh, and I have noticed there is a slow and a steady rollback of branch network in some markets, and the same is being replaced by very focused digital banking features. From your perspective, how do you see this? Does it have something to do with shifting the mindset of the customers, as well as digitizing the branch banking services to ensure making banking services a lot more convenient for customers? What's your take on this? Over to you, Wane.
Absolutely. So one of the things that is definitely happening, and it's a shift that's not only unique to Zambia or my region, I think it's a pattern that's cutting across the continent. Profitability of a lot of organizations is currently being impacted, and cost of acquisition is one of the big challenges that is existing. The traditional channel for acquisition for a bank has always been the branch infrastructure. Now, the question that we are all beginning to ask ourselves is, in the wake of declining margins, how do we address more efficient ways of approaching our operating model? What that has shown is that we've started to unbundle particular segments. For instance, the segment that you have talked about around customer acquisition and service of the customer has been faced with the challenge of saying, how do we unbundle it using technology to recreate the same scale and the mass with even a much higher velocity or potential? So one of the things that we have done is we have embarked on branch rationalization in Zambia across our branch network. We had 70 plus branches across the country, but we're gradually scaling down in terms of the number of branches. But the expectation is that we should not slow down on customer acquisition. If anything, we have actually quadrupled in terms of our acquisition capacity. And I'll give some very precise examples. Using APIs and acquisition platforms, we're able to initiate customer acquisitions, one through via interfaces such as cell phone boarding using mobile channels, whether it's USSD or even the mobile app, and basically streamline the traffic that's going into the branch and empower customers to be able to use the app in the comfort of their palm and onboard themselves. But then there's also newer models in terms of servicing consumers as a bank. And this is, again, not very unique to Zambia. I think Zambia has been on the slower side in terms of the uptake of agency banking. Again, agency banking is purely technology-enabled solutions. So the bank now has the capacity to drop its cost around branch distribution. So we're going from 70 odd branches with a plan to scale down significantly, but we are not slowing down on servicing the existing customers. All this is powered by pure technology. Very practical. We are ahead of the market in terms of our particular geography. But if you cut across to markets like Kenya, this is something that I think is traditionally being used quite aggressively, same as in Ghana as well. So it's very exciting for us as Zanaco to be the front runner on this, but we're seeing a lot of competition coming from partner neighboring banks within our market. And again, it's all being driven by profitability. We are driving an agenda to increase our profitability. Cost of acquisition is one of the problem pain points. We're borrowing technology, we're borrowing models from alternative channels or businesses such as telecommunication, and we're able to roll out much more effectively.
Good. Let me come to Hartnell this time. And I was going through some data, and what I noticed that as per World Bank data, only 43% of adult population in Africa has either bank account or a mobile money account. And if you look at the current situation, I think it is a big barrier to enable government benefit schemes to masses. How you think that the current crisis would be taken as a learning, and we will deploy digital technologies, maybe in partnership with non-bank players, and bring the remaining masses into financial inclusion? Over to you, Hartnell.
Thanks, Raj, for that question. So I really like discussing this topic, and why I like it is because it brings about two key concepts that I really have interest in. One of them is financial inclusion, ensuring that we are able to include the micro and the different kind of unbanked customers within the financial services realm. But the second one is also digital inclusion, which speaks to connectivity and speaks to the last mile connectivity. Because if you think about financial inclusion, what has made it, and particularly for markets like Kenya, what has made it to actually be able to roll out successfully is because of the mobile phone device. I think M-Pesa was a liberation within Kenya, and we were able to ensure that people could transact and conduct their normal businesses by either borrowing loans on their mobile phones or transacting like a bank on their mobile phone. When you speak about how do we accelerate this, then we actually have to ensure that these two concepts are working together. Digital inclusion speaks not only of ensuring that people have mobile devices, but also speaks to content, speaks to design of applications, speaks to ability for fintechs and startups and banks who are partnering with third parties to develop solutions that can actually benefit the customer at the last mile that you're looking at, including them within the financial realm. So I like speaking and driving this and saying that this is the time where banks should think about partnering with third parties. Most people like comparing banks to big battleships or big ships that cruise on the ocean, but they're not as agile as speedboats. So you do need to partner with a speedboat so that sometimes you have to launch and get to a different part of the sea quicker than having to navigate a big battleship to just take a mere turn on the ocean. So we have to think about partnership, and with partnership, we have to be very strategic. Looking at partnering with telcos to drive digital inclusion. I think now telcos are already speaking to ensuring that they're not only selling voice and data and value-added services, but also mobile devices. And I'm liking that you're seeing different kinds of offers to ensure that people are able to afford smartphone devices. Other than just looking at devices and data, we have to think about the content. We have to think about supporting startups who are developing content that can help someone within their financial services realm. Apps that can help people sell milk from the different parts of the country, can help traders be able to come together and have a better bargaining power with regards to selling their produce, whether it's tea or coffee. So we have to think about ensuring that we're not only driving the adoption of devices only, but also think about the content, the applications that support financial inclusion. And this is the best time for all of us. I think COVID has shown us that we have to really be able to know that we can, as human beings, we can transform at the snap of a finger. Most people do not know how to use Teams and Zoom. Now I can tell you some of these companies are the most profitable companies in the last few months. And we can actually decide, and it can be deliberate, that banks decide to extend their arms. Some time back, it was all about fintechs and startups coming to big organizations and requesting them to partner. Now it's time for banks to go out there and start supporting and selecting what kind of third-party organizations can we really partner with and ensure that we're driving two things: financial inclusion as well as digital inclusion.
Perfect. Thank you for this insight. Wane, let me come back to you again. Some of the markets which are similar to Africa, I mean, if I can relate with some markets in Southeast Asia, there is now the adoption of eKYC is very high. And I personally feel, the KYC is one of the key element in onboarding individual clients. If we just talk about individuals, how you think that in a post-COVID changing scenarios, do you think there will be a large-scale adoption of eKYC as a next big innovation in Africa?
So it's definitely a very interesting area to actually address around the KYC aspects. And one of the things that I think is predominant across the African continent is the identification aspect of consumers when onboarding them always seems to pose a challenge. I know there are markets such as Tanzania that have adopted a digital identity database. Tanzania and Uganda and Rwanda have been working on a digital identity database. Now, with that, I am aware that there are some fintechs already that have created very lightweight type of technology that links into these national databases from an identity perspective. What that does is it enables KYC process to run a lot more efficient. If you look at the African continent, validation of identity is a big topic on its own, because for starters, a good amount of population don't have formal identity across Africa. Now, this poses a challenge for anyone who is required by law to onboard customers using KYC. So that will speak to the telcos, that will speak to the banks. Now, for me, this is just simply friction. Friction in a financial system, friction in a telecommunication system that needs to be solved. The opportunity is absolutely immense when you ask me. I think the efforts that is already happening across different markets, some markets slightly ahead of others, is we have got third-party players who are enabling the whole functionality around KYC. Now, for me, that's one of the key ingredients to solving the challenge around financial inclusion, especially in the time where we are all pushing the digital inclusivity agenda. We're trying to get everybody into a cashless society, but the first step in context of Africa is around how do we increase the needle from a smaller consumer base that are currently financially included to increase it to maybe 60 to 70%, which is a significant number in terms of bringing people on board into our environment. And the KYC aspect is one of the friction points that has been identified. A lot of effort already is going on, at least from the banking sector, from the telco sector. But more importantly, I think we are getting a lot more third-party players who have identified the pain point and are coming up with more innovative solutions on the continent.
Perfect. Dennis, on the same eKYC, and if I can share with you guys, and in India these days we are talking about adoption of video KYC, moving up from the eKYC. Dennis, you think is it the right time to start the real conversation between the banks and the regulators across the continent in terms of faster adoption? And I know this requires a lot of government involvement also for the adoption of eKYC.
Okay, I don't think there's any right time. From what we have seen, technology, innovation, especially innovative companies, consumer behavior will lead and will push that. Unfortunately, the regulators, and I think this is worldwide, the regulators are a bit slow to catch up. So the market usually leads and then they call everybody, hey, come back. We need to put some structure around what you're doing. So I think that time will always be determined by innovation and by consumer behavior. In Nigeria, for instance, a number of years ago, quite some years now, we came up with digital identification, the bank verification number that everyone who has a bank account must have for you to operate an account. So I think such schemes help that thought, moves it along. Now, to the nexus point between the innovation and the regulatory body, I see that, so even whilst the regulators are a bit slow, the push, just the sheer need to be able to regulate things that even they don't seem to understand. You know, it's already pushing them to play catch up quite seriously. The future I see there is so RegTech. RegTech is not something we talk a lot about, but RegTech is there. And I think so. So partnerships between RegTech companies and regulatory companies, I see that coming to the fore, where regulatory issues are done on the fly. You know, a lot of that is happening now, but I'm talking about being able to translate a regulatory policy into an active code that helps to mitigate risk at the end of the day. You know, and all that can be seen as a value, positive value in KYC, where, and I'm happy to hear what you're doing in India, you know, but that can be seen as a positive value in KYC, where, for instance, we have quite a lot of outdated laws, outdated in the context of modern reality. So in Nigeria, for instance, most things need to be signed in wet ink signature. Now, if you're in the retail consumer segment, that's not such a difficulty, because when you are the sole signatory to your account, and so when you acquiesce, when you are sent online, that's taken as your consent, and that can be exchanged for a wet signature. But when you are a company, again, remember I said I'm in the SME segment. But when you are a company and you have a matrix of signatures, it's a bit difficult to start building. It's not impossible, but it's more challenging to build an electronic signature mandate to replace the wet signature. But moving beyond that, we also need a regulatory framework to allow such things work. So again, I would rest my answer on what is being driven by innovative companies, and especially in RegTech, to pull in the regulators so that we can begin to see those kinds of benefits in KYC. We're already seeing some. We're seeing some, quite frankly speaking. I mean, we have local entities in Nigeria who, so if, for instance, one fintech company has validated a consumer or a business, you can rely upon that validation, effectively sell that validation to other parties, you know, but having it within a structured context where the regulators are involved, I think the RegTech would lead with that. Yeah.
Perfect. Thanks, Dennis, for this. I think, you know, when we talk about digital transformation, it should be not just within the one company or the other company. It should be a holistic discussion within the country, within the region, etc., and bringing every body together. We can see within just months, the world has been flowing into digitization unusual, as businesses seek, ways to stay above water and ensure continuity post-crisis. I personally feel those who had embedded digital transformation as part of their core strategy has been able to move a few needles quickly, but those who had concentrated more on day-to-day operational activities are struggling during this unusual crisis. But I'm sure this crisis will be a life-changing lesson for all of us when we return to the new normal. I'm told there's a lot of audience questions are coming in. So I would like to bring in Fahad to take us forward.
Yeah, we have a question here. How enterprise architecture benefits the banks in reshaping digital banking? Would like to take it?
I can take it. Okay, yeah. So I like the participant who asked that question, because I think the person is looking at the end-to-end view of banking, from onboarding to servicing, and also to some extent being able to actually let go of the customer in a nice way.
I'll take his name. I'll take his name. His name is Shimalis Waseni. Yes, the speaker likes your question.
Yeah. So basically, when you talk about enterprise architecture, I think it's shaping both data and digital transformation. And the reason is this: when you're actually moving away from your brick and mortar banking space to a more digitally transformed organization and a bank, you have to actually ensure that you have a loosely coupled enterprise architecture. So people actually moving away from a system whereby you had very large service buses running so many checks on different systems, and that is your main format of integration, to now using more of APIs and microservices. So we are seeing also a transformation within the enterprise architecture space, and this cuts across one data architecture, ensuring that you're also able to know the data flows within your environment. How do we get the right kind of information from the customer journey, from interaction to service delivery? You're also having technology transformation, which ensures that we are moving away from very bulky and archaic service buses into more loosely coupled architecture, which is basically APIs or micro services. Then we're also seeing transformation on process architecture, ensuring that we are also able to ensure that our process take up to 3 or 4 steps before a customer gets a service done. And this speaks to also ensuring that you're doing away with manual handoffs within integration of services, integration of processes. And all this actually sit under the umbrella of enterprise architecture. So it's key to note that as you're thinking about digital and data transformation, you have to have a seat for the enterprise architect. Someone who can speak both the system language of ensuring that he's able to transform your architecture the way it sits to ensure that it's loosely coupled, and be able to actually deliver the expectations with regards to the digital services that are required from the customer lens.
Shall I take the next question?
Yes.
Yeah. I guess this one is pretty much because from the nature of the question, I guess Wane will be the best person to answer this, because it's purely CDO, Chief Digital Officer focused question. As we invest more and more on digital, the cost of fund increases. How can a bank be profitable? So unmute. Wane, can you unmute? Yeah.
Thank you very much for that really insightful and mind-jogging question. The reality is that the cost of doing business in the traditional model is not sustainable for the future. Now, the point you're raising, the cost of funds are obviously being impacted. And the way banks are traditionally structured is we're structured in such a way where we were not necessarily built for digital business, which basically speaks to high volumes, high scale, which requires very relatively pricey technology. In terms of solutioning for that, the way banks need to look at banking going forward, and I always like to give a very loose analogy around dropping a bomb on the bank and starting afresh. You probably have more creativity if you started from zero than trying to mold traditional old style technology, processes, and data structures to suit tomorrow's bank. Now, how to solve this question looks at how you unbundle traditional banking services. What that means is different streams of banking need to be broken into microservices. So if you look at distribution as one of the areas, traditionally the bank used a fixed cost infrastructure. Now all these fixed costs get built into the margin of the product. Now, if you continue running traditional big models or heavy models of delivery, it actually compromises your profitability as a bank. Now, the way to solve it is you unbundle your service and you go into what are called collaborations that basically unbundle some of your costs. I will give you a very good example. In telecommunication, this is from a previous life, telecommunication has got a very lightweight variable cost distribution model. What that means is telecommunication companies don't pay for your physical infrastructure. They pay per use. So the more your consumers use, the more you pay for the service, which makes it a more variable model and a more manageable way of managing your distribution of costs. So today what banks are doing is they're closing down branches and they're using technology, using your mobile phone technology and using agency models, which is on the business process side, to basically reduce the cost of servicing consumers, ideally helping manage the issue of declining margins and being able to provide much better and more efficient services. And this is literally in the total perspective of a bank, whether it's on wealth management, product creation. There are third-party players that can deliver more agile, more cost-effective solutions for the bank to be able to do what it was doing traditionally for a higher cost structure. So this is something that every bank is going to face, whether it's now or in the near future.
Okay, great. There's one from Mr. Suhailuddin. Uh, I know of a micro lending company that profiles a user's credit worthiness based on their social networking profile. Do you think a regulator will no? Do you think a regulator would ever allow KYC in brackets light touch to be led by an individual's Facebook account? Yeah, we have a data guy and we have a business leader.
I'll let the data guy
Dennis,
go.
you'd like to take it? I like to hear from Dennis, but yeah, I can give a stab at it, and I can tell you yes. Some in my previous life, I've actually thought of using social media data to actually augment the customer persona and the customer profile. Because what you're trying to do is actually be able to determine who is your customer and can I trust them when it regards to lending and giving them money so they can repay back. Unfortunately, what I discovered is that when you're talking social media data and you're able to rank it with regards to dependability, I think the rank is really low. And the reason why this is so is because most people on profile on the social media are trying to put their best foot forward. So they will not actually sometimes give the truth. They will try and alter the information just to suit their social media outlook. And that makes the data, as you augment it to create a persona or a profile that can actually determine a credit score, less dependable. Number two, I also went ahead and we tried to actually fit in some social media data, which was scrubbed, and we discovered that if for those who are statisticians on the call on the webinar, you actually have a very low information value score with regard to social media data, the probability of a customer paying back your loan. So statistically, it actually fails with regards to becoming a strong predictor of loan repayment, and you can actually not depend it when you're actually fitting your model that is going to be predictive. So what I actually tell people is that you can actually use social media data to augment and not really as the final source of data that you can use to determine the credit score of your customer. So use it to augment, either to validate what does the customer like with regards to preferences, what other kind of connections, what other kind of connection does the customer have? Because you do have graph analytics, which will help you know how connected is this person, what kind of people does he relate to. So you can use this to augment your data, but you cannot use it solely as a customer predictor with regards to loan repayment. Will the regulator allow this? I think we have to think about what is dependable first, because you already have the regulator not even solving with regards to what is already working well. So I'll say let's take it slowly. I usually say when I'm discussing regulatory matters, I don't like saying that regulators are actually playing catch up, even though in quotes they are. I think it's time to work with the regulators. We are recruiting very senior skills and teams within the banking environment. I think it's safe to say that for different reasons, they may not be able to do the same. We may not be hiring chief digital officers and data scientists every day, but we can work with them. Let's tell them about the things we are involving in. And yes, they will be able at some point, be able to know how we are using social media data for credit score systems and engines and know how to regulate it better. But for now, I'll say, number one, just use the social media data for augmentation purposes. And for the regulatory part of things, let's work with them. There's still a long mile before they're able to actually start speaking of regulatory information.
If I can just add to what Hartnell was saying,
Yes,
I mean,
sure.
in the continent there are fintech companies who are in the lending business and completely solely relying on the alternate data sources. So they are not even going and visiting clients. So they depend on the mobile data as well as the social media data to do the customer profiling, and then they decide their borrowing capacity. So I think in future in banking, I think the alternate data sources are going to play a very big role in terms of lending. Yeah.
Great.
Yeah.
Wane,
If I may just add another 60 seconds on the topic, I have a rather contentious point that I always drive. If we're going to rely on traditional data sources, 70% of Africa will never be formally, properly included in financial service. And that's the reality. Majority of the consumers in Africa, 60, 70%, don't have any traditional financial service data. Why? Because they've traditionally been excluded. So the only way we can really push forward, and I agree that social media data may not necessarily be the most effective, but we all need to concert our efforts together to be able to take that component into the future, to be able to solve Africa's real needs, because we are currently struggling with real challenges around financial inclusion. And until we start thinking differently, we will continue facing the same problem with the same answer and not making real traction when it comes to financial inclusion.
Absolutely.
Thank you. Thank you. We'll have to proceed for the closing. So any final key takeaway from, unfortunately, Dennis had to, we lost Dennis due to some connection issue at his end, but it's a little bit out of everybody's hands right now. But he extends his gratitude to all of you. He extends his gratitude to you, Raj, and it was really a privilege of having him on the panel. Yourself, Hartnell, and yourself, Wane. Any last 10-second closing statement from the two of you?
So I'll go first.
Thanks.
Thank you very much for the opportunity to be here. My honest opinion, it's very exciting times we live in. With every dark cloud, there's a silver lining. And I honestly believe that even in the midst of the whole COVID pandemic, there is a shift in consumer behavior that I think in the next 3 to 5 years, we shall all really truly appreciate if we continue to work together.
Hartnell.
Thanks. Thank you so much, Fad and team, the Africa Bank 4.0 Summit. My parting shot will be, the time is now. If you are someone within an organization that is not transformed yet, please take the step, start looking at how you're going to change your strategy, take up a course on data science, on digital transformation, and make sure you know exactly what is coming ahead. But with regards to actually the shift to digital transformation, I think the time is now and we all are supposed to ride with the wave. Ensure that you're also driving this, particularly from your own basis and also for your organization. Thanks.
That's.
I think this is a very good crisis to have, and it will only result in a good crisis if we act today. And I personally feel, talking to so many bankers, that the most important thing which they are going to do tomorrow is digital transformation, and everything which they had planned earlier to do in next 4 to 5 years, they are going to do in maybe next 1 to 2 years or even before. So I think that's how this crisis has changed people's mindset, and which I personally feel is good for the industry. Lastly, thanks to everyone for joining this panel. It was amazing part. I will suggest if we can do maybe a conference on RegTech or InsurTech in future.
Sure.